Hi everyone, I'm Sumaira Abidi and I'm very happy to get this opportunity to speak to all of you who are visiting India this year. Markets appear to be on a tear, the economy is dashing towards the $5 trillion mark, and yet many of our portfolios still reflect the investment choices we made years ago. We are currently living in what is being called India's decade, and it's time for us to upgrade our portfolios to reflect this transformation. So there are two aspects to this: why and how. Ruchit Mehta, our head of research, will help us in answering both questions. Hi, Ruchit. Thanks
Hi.
very much for doing this because, it almost seems like so many good things are coming together, right? So all strategists seem convinced that there is a long runway of growth ahead, which, if you're looking at it sitting in India, seems awesome. But what about somebody who's an NRI, right? Because they have to also worry about, say, rupee depreciation as well. I mean, the world is their oyster, right? They have so many other enticing opportunities. So, what is the case for them to invest in India?
Sure. I think for an investor who is outside of India, obviously they have a lot of investment choices available to them. But here's why India kind of stands out amongst a wide range of options, right? Um, India is an economy, right? You're at a very interesting juncture where you're probably around $2,500 per capita. Growth is very strong. So we just saw the Q2 GDP results come through last week, and it's at about 7.5%. Growth is only likely to remain at the current level, if not, it accelerates from here. Right? So you've got very good, solid growth come through. But from an investor standpoint, right? Growth is there available in a lot of markets, right? What is unique about India as a market is that one, it's a very well diversified market. So when you look at a lot of other emerging markets, which typically is India classified into, you would see that there are one or two sectors which dominate the market. Say, for example, Russia, right? It's very heavy on the commodity side, particularly on the oil side of it. Or Brazil, again, very heavy on the commodity side, but more of the agriculture side. Or take Taiwan for that matter, right? You have a lot of semiconductor and high tech industries. So you tend to have one or two sectors which dominate a particular economy and therefore the market that's there. India, in that sense, has a very well diversified set of industries and representation in the market. So, if you look at our Nifty, we've got about roughly one third in banks, you've got about 10 11% in IT, FMCG, automotive, pharma, technology, etc. So, you have a wide range of sectors that are represented in the index. What this does mean is that over the longer period of time, India has very stable earnings and very good ROEs and stable ROEs over a longer period of time. This has resulted into India having a PE premium over all emerging market countries across the world. So historically, India's price to earnings multiple always has traded higher, and that's because it's a diversified market. It's got solid earnings trajectory and very good ROEs over the longer period of time. And therefore, that makes India a very compelling case when you're looking at it from an investment standpoint. I hear you on the dollar depreciation side of it, and everybody tends to worry a lot about it that do my rupee returns get eaten away by the dollar? But here's an interesting stat. If one looks at it over the last 20 odd years, right, and if you look at the dollar returns, outside of the US, India is probably among the top one or two countries that have delivered dollar returns, which are comparable to where the US is, right? So if the US has delivered a certain degree of returns in dollar terms, India is very close to that. So even from a dollar return perspective, India as a market works for you.
So, in that case, how much of India exposure would an NRI need? Okay, I mean, I can imagine it can be a little bit more than what might be to other countries because, after all, there's a tendency that you'd understand this market better than others, right? So, say between their other overseas portfolio and India, what's a good mix?
If you're an investor who's not invested into India, I think you should look at it that India should be anywhere from about 15% to 25% of your portfolio. And this is because India will offer you solid diversification in your equity portfolio. And as I said, offers you very strong earnings growth potential as well. So, for an investor who does not have any allocation or has a little allocation, I would recommend that you should be anywhere from 15% to 25% of your equity allocation into Indian equity assets.
Yeah, at the very least.
At the very least.
Okay. What kind of, and this is long-term money, right? What kind or what category of funds are well suited for this kind of investment, which would typically be, I think, 10 years plus?
So if you're looking at a horizon which is around 10 years and there, I would recommend that investors look at essentially three categories of fund, right? So one is that you have funds which are in the focused fund categories, right? Focused funds tend to be a lot more concentrated in the investments. You have a smaller number of stocks, typically around 25 or 35 stocks, so roughly between 25-30 stocks is the average allocation. Here the fund manager is focusing on a few high conviction ideas and making a higher allocation to them. And over a longer period of time, we've seen that focus funds can deliver better alpha over the market in general. The second category of funds would be the mid and small cap area, right? Because you have a 10-year horizon, you can generate significant alpha over the longer term if you have allocations to the mid and the small cap side of it. So that is something that I would sort of recommend investors look at. The third is that you may want to look at having something in the large and mid cap space as well, right? So if you look at our large and mid cap fund, over the last 20 odd years, it's delivered returns which is around 19% CAGR. Now, even if I knock off, say, 4% average rupee depreciation, that's still a pretty solid 15% dollar CAGR returns, right? So and because it's invest judicially between large and mid cap stocks, so you get a flavor of both the large cap universe in India as well as the mid cap side of it. So three buckets. You have the focus category of funds, the large and mid cap funds, and the mid and small cap category as well.
Okay, the final question is that, why SBI Mutual Fund, right? Now, we do things a little bit differently, which is that, we'd rather focus on safety first, liquidity second, and returns third. Now, for a new investor or a lay investor, they may think that, will I lose out in the long term because returns are coming third? So can you explain why this philosophy and what does it mean for the investors?
Sure. You rightly pointed out that we do things a little bit differently here at SBI Funds Management, and one of the bedrocks of our investing style has been that it's pretty much research focused, very much bottom up oriented. We focus a lot more about the company that we are going to be investing behind it. We will spend significant amount of time and effort in trying to understand the business, the people who are running that business, why one should consider that as part of our investment portfolio, and that kind of reflects in the way we have invested as well. So there would be a pretty large number of companies where we will be owning anywhere north of 5%. In many cases, we are owning about 9.5-10% of the equity as well, and we hold them through many years as well. Now that happens because we have a process in place which enables us to build that level of conviction that's there. So as a fund house, we've always believed in a research driven approach. The second is that we are very much process oriented. So for an investor, one key aspect is that do they have consistency of an investing experience through the years, regardless of market cycles and regardless of the portfolio manager as well, right? And that's important because you don't want to be, say, investing in a fund which is categorized as something today and then see that the nature of the fund changes over time. So what we have been doing over the last 10 years is that we've implemented a process by every fund has a very well defined fund philosophy. We have templates in place which essentially tell the fund manager that what they can and cannot do, how much they can buy into a particular sector, how much overweight or underweight in a stock they can go on, etc. Now, these are templates that kind of operate like guardrails for a fund manager, right? And third is to outline a very core philosophy around the fund and the investing style behind the fund, so that no matter who the fund manager is, right, you will see a similar investing style when even the fund managers change. And in the past, when we've seen changes in fund managers for portfolios, we've seen that the process has ensured that there is continuity of the investing style from one PM to the other, and that's meant that the investor has a consistent experience. So I think one of the bedrocks that we always tell our investors, why do you want to look at SBI funds? We are research driven, we are bottom up stock pickers, and we are process driven. And that makes sure that we are a team driven approach and not individuals or stars or celebrities. So one of our favorite questions that we tend to ask everybody in large investor meets is that, do you know who manages X fund or Y fund? And individual people don't know. And we think that's fantastic, because it means that people are trusting the brand, people are trusting the team and the process over an individual that's there.
Yeah, absolutely. And when you say we're a research-driven team, I must also specify that SBI Funds Management is the largest research team of, I think now 69 people.
Yeah.
So the kind of research arbitrage that brings to the funds management is almost unparalleled. So Ruchit, thank you very, very much for joining us. And I hope you find this useful. Thanks for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.